Should you buy long-term care insurance? This is a question I get all the time. Just talked to my friends out in Omaha, Nebraska this morning, or this afternoon, and they asked them that. And generally speaking, the questions comes from the wife, which makes sense because typically the husband dies, the wife takes care of the husband, wipes his butt, does all that stuff, that he dies, then the wife is left by herself, and at some point she may or may not need assistance. And if she does, what usually happens is she sells her home and goes to a long-term care facility. It's just really that simple. About 15% of the people go to a long-term care facility, and about, I think it's like what's the median stay? It's less than a year or something. I can't remember. So there's a very few group of people that spend more than 2 years in a long-term care facility. Very, very few. Now, that doesn't mean it doesn't happen, because those people who do spend more than 2 years are spending a lot of, even those who spend a year, spending a lot of money in long-term care. We'll just say the average is $10,000 a year. We'll just use that for example. Not $10,000 a year, $10,000 a month. Excuse me. That's not the average. But let's just use that. That's $120,000 a year. All right. So let's just say you're there for 4 years. That's almost $500,000, dude. You know what I'm saying? That's not chump change. That's just a fact. So the question is, should you offset that risk by buying a long-term care policy? Now, people will make the argument, well, dude, you have a house, you have a homeowner's insurance. You definitely want a homeowner's insurance to protect you in case your house burns down. Long-term care is the same thing. Now, I get that. There's not a very high likelihood that your house will burn down. There's not a very high likelihood that you'll go and spend a lot of money in a long-term care facility. Just not. The difference between those two components, though, is that you might have my house is easily worth $500,000. Hell, we bought this house for $589, 10 years, 11 years ago. So it's probably $1 million now, I imagine. I don't know. So let's just say it's $1 million. All right, so we pay $2,000, $3,000 a year for $1 million homeowners protection, something like that. I don't know the exact cost off the top of my head, but you get it. A long-term care policy, you're going to pay $700 or $800, probably $700 a month, even $600 a month. That's $8,000 a year for what? $400,000, $300,000 of coverage. You see the difference there? The difference between homeowners insurance, where you have this huge asset, it's your biggest asset that you have, and you have a relatively small premium because the likelihood of you needing it isn't very high, versus long-term care, which you have a high premium and a much smaller coverage amount. That's not saying you should not buy long-term care. I have long-term care insurance. I do. We bought it when I was 38 years old. I'm 53 now. We bought it 15 years ago because we had a big fat mortgage. I still have a mortgage, not big fat anymore, but it's a mortgage nonetheless. My wife wasn't working. We had 4 young kids. You see what I'm saying? We bought it when we were in New Jersey. I bought it for the Knights of Columbus, a fraternal Catholic organization. Got it both my wife and me. Because I said, if I need long-term care, if I have to go to a facility or need in-home health care for some capacity, that means A, I'm not working, right? If I have long-term care, I'm most likely not working. And B, we don't have any income coming in to pay for the mortgage to anything like that. Nothing. On top of that, we're going to have to pay for the long-term care that I need. My wife would be she'd be skunked, man, if that were to happen. What the hell? How would that work with a family of 6 with 1 income? So I got it, and I'm going to keep it until probably about 60 years old or so. When the debt's paid off, the kids are out of the house, then I'll get rid of my long-term care insurance. Because I don't think that it's a good investment from an insurance perspective for long-term care. I don't think you get enough coverage for the premiums that you pay. They don't have any more of these inflation-adjusted compounding. Like basically right now, they used to have unlimited coverage. Inflation-adjusted compounding at 5% for as long as you're alive. They don't do that anymore unless you're going to pay millions of dollars. So now it's like 3-year coverage, $250 a day with a 3% compounding, which is good. Don't get me wrong, but you're still not covering what it used to be in the old days was literally unlimited amount of coverage. $200 a day, 5% compounding for $300 a month. I mean, you can't shake a stick at those policies. Those are no longer issued anymore. So basically, you have this certain pool of money you're protecting. It's usually $300,000 to $400,000, if even that. You're buying a certain pool of money to protect you against long-term care. Now you say, okay, if I get long-term care, it'll cover me for $300,000 to $400,000. Now it might inflate, it might not. It might not be compounded. It might be simple. So if you got $300,000 is inflating by 3% a year, simple, that means 300,000 is 309,000. The next year, 300,000 will be 318,000. The next year will be 327,000. And also the premiums can go up too. My Knights of Columbus policy goes, I get a letter every year, guaranteed something, a premium option where you can increase the benefit by increasing your premiums if you want. And sometimes I take advantage of it, sometimes don't. But I know full well that I'm going to drop my long-term care probably by the time I'm, like I said, by 60, if not even earlier. So then you say, okay, so, and by the way, the older you get, the more expensive long-term care becomes. So let's just say I have, we're going to say it costs me $500 a month just for simplicity. And we're just going to give myself a 5% rate of return. And I will say I'm 55 years old, and I don't expect to need the long-term care until I'm 85. So that's 30 years at $500 a month. Let's see what that grows. It grows to $416,000. Now let's just say I bought that long-term care that provides me $350,000 of coverage right now. So $350,000 of coverage is my present value, and we're going to say we got a 2%. We're going to say 2% because a lot of these are simple interest. I don't know how to do simple versus compounding in here because it's been so long since I've done it. We're going to do simple interest. We're going to do 30N, and we're right there. Oops, 1 second. Let me do this again. 360. Got to do 360N. There we go. That give me the equivalent of $637,000 of coverage. So a lot of people make the mistake, say, "Well, I can save my money, $417,000. It'll give me more than my long-term care." Well, your long-term care, if you have inflation adjustment of some sort, will grow more. So basically, I'd be paying $500 a month for $637,000. You can hear my dog. $500 a month for essentially $637,000 of long-term care coverage by the time I'm 85. Or I can just invest that $500 a month and have, I forgot what I said it was going to be. I think it's $400,000 or something like that. Now, because the idea that you're not probably going to need that full $637,000, if any of it, I'd rather have the $400,000 to myself, frankly, 100%. Because the premiums are first of all, I got to be underwritten. And the older you are, harder it is to get underwritten. Secondly, the premiums are not cheap. And thirdly, they can go up. They can. Now, I'm saying a flat premium of $500 a month with an inflation adjustment, 2% simple interest. And again, I'm not doing simple in there. I don't know how to do it on that calculator. But you get the gist. So there's pros and cons of getting long-term care. For me, I don't think it's worth it. I think I'd rather take the risk and self-insure. It's like the people I talk to today say, look, even if I killed the husband at 80, I said, sister, even if he dies and you need long-term care, you got a house that's worth $550,000. You just sell. That's what we're doing. My mom selling her home. She's got pension and not pension, annuities and Social Security plus a house. She don't have very much money, but she has, a decent little bit of income plus a house that she can sell. So I said, worst case scenario is you sell the house. Even that, she still had, a decent amount of liquidity left over that she could use for long-term care, and they don't have any kids. You know what I'm saying? So I was like, yeah, dude. Long-term care. I mean, I will never tell somebody they don't need something I don't know. But I'm like, the risk versus reward here. The risk is quite low in terms of your inability to provide for yourself, self-insure. The reward is quite low too, because you can self-insure. And the other hand is you can have that money for yourself. Right? You have to go get my dog. So that's just my take on it. I think if you have kids and you got debt, especially if you just got one income, I think you need long-term care. I also think your spouse needs life insurance, by the way, as well. Because let's say you have a stay-at-home mom and she died. Dude, who's going to watch the kids now? Your dog? Loudmouth McGee out there? You're going to have to get someone to watch the kids when normally they were at home while you could work. You got to get life insurance for your stay-at-home spouse as well as you need to consider long-term care if you have big debt, and you're young, because it's cheaper when you're young. That's the point. You always want the insurance when you don't need it. That's when it's the cheapest. All right. God bless. Love your thoughts. See ya.